So salary sacrifice provides often the most significant benefit to help you boost your superannuation and save tax. How salary sacrifice works is that if it's best to explain what normally happens. So if there's no salary sacrifice arrangement in place, then your employer, before paying your income to your bank account, deducts some tax. And the tax rates are dependent, as we saw earlier on that chart, are based on what your total income is. If you're earning between $18,200 and $37,000, your tax rate is 31%. Between $37,000 and $80,000, it's 34%. $80,000 and $180,000, it's 39%. And if you're over $180,000, then your marginal tax rate is 49%. So they deduct that. Your employer deducts tax at these rates before they pay your income into your bank account. Now, once it's into your bank account, you can then spend the money, you can save the money, or you could put some extra money into your superannuation account. Now, in the scenario where you're salary sacrificing, rather than your employer, or before deducting tax, what your employer does is directs some of your income to your superannuation account. Now, they do this before deducting tax, and the key benefit here is that it reduces your taxable income. So your employer puts money into your super account, your super fund then deducts some contribution tax, and the rate at which they deduct the tax is either 15%, as we can see here, or 30% if your income is over $300,000. Now, after your employer has made that contribution to super, then they deduct some your pay-as-you-go taxes deducted, and that's then at a lesser rate than the amount if you weren't salary sacrificing, and this is where the benefit comes in. So after they've deducted less tax because you've put money into super, then money will go into your bank account. There's generally less than what you will get up here, and then you're able to spend the money, save the money, and you could even put some money into superannuation as well. But the key benefit here is the difference between what you would pay on income tax versus what you would pay of contributions tax. So the difference between these two things is your benefit. So in this case, if you're earning between $18,200 and $37,000, salary sacrificing will give you a benefit of 6%. If you are on 34% or 34.5% tax rate, you're earning between $37,000 and $80,000, then the difference between these two is 19.5%. Nearly 20% tax saving. So I often use the figures, if you salary sacrifice $10,000, then you're saving close to $2,000 in tax by doing that. That's money that's in your pocket rather than the government's pocket, and that's where the tax savings are. If you do that year on year, that's a lot of money that's going into your bank account rather than into the government's.